Hello everyone, welcome to EduTap and welcome to today's session, that is the monthly revision session for your RBI notifications and RBI press releases that were released in July 2025. So we are going to discuss the most important and we are going to discuss and revise the most important and most relevant RBI notifications and RBI press releases that were released in July 2025. Okay, so I hope you are ready for today's session and you have revised well the RBI notifications and RBI press releases, and you will be able to give the right answer of all the MCQs that we are going to discuss and we are going to talk about today. Okay, so before starting with the session, give me a thumbs up if I am clearly audible and visible. And today is your monthly revision session for your July RBI notifications and RBI press releases. This is a very important month from your examination perspective for the RBI grade B or RBI grade A examination. Okay, so good evening everyone, good evening and welcome to the session. So give me a thumbs up if everything is fine. So now before starting with the session, do subscribe to the YouTube channel of EduTap so that you continue getting the relevant videos, and do join our Telegram channel where you will get the PDF of the session, and the link for the Telegram channel is provided in the description box below. Okay, so let's get started with first question. So this is the first question in front of you. This is regarding the digital payment index. So RBI has been publishing a composite Reserve Bank of India digital payment index since January 1, 2021 to capture the extent of digitization of payments that has happened across the country. So there is the penetration of digital payments. Okay. So now which of the following statements is or are correct in regards to the RBI DPI, that you have to tell me. Okay. So the first answer I am getting, Guru Raja has said D. So first of all, RBI DPI has been constructed with March 2018 as the base period. That is, DPI score for March 2018 is set at 100. So yes, for the digital payment index, the base year is your March 2018 and the value of the base year is 100. Okay. Now the DPI for March 2025 stands at what value? Do you know that what is the value for the DPI for the March 2025? As against the value of 465.33 for September 2024 and 445.50 in March 2024. So for the DPI for March 2025, the value was 493.22. Now this value is very important because the digital payment index value is very important. Okay, and the value is 493.22. It is not 483. Okay, the increase in RBI DPI index is because of which factors? Mainly it is because of payment infrastructure, supply side factors and the payment performance. So the first and third statements are absolutely correct. The second statement was wrong, and that's why the answer is 1 and 3. That is D. So I give yourself 1 marks if you have given the right answer of this question. Okay. Now moving forward, we have discussed about the Reserve Bank of India Digital Payment Index in the Finance 360-degree session. So I hope you have seen that session and you know that there are 5 parameters in the digital payment index and the highest weightage is given to the payment performance. Okay, so do study about digital payment index if you have not studied it. Next question is regarding your small finance bank. Now the small finance bank has to provide 75% of its adjusted net bank credit to the priority sectors. Okay, so that means small finance bank has to provide 75% of its adjusted net bank credit to priority sectors, out of which it is determined by the Reserve Bank of India as per the PSL guidelines. 40% is provided to certain sectors. Okay, while 35% the small finance bank can decide that 35% of the A and BC can be provided to like sectors that the SFB wants, that the small finance bank wants. Okay, so the 35% of the 75% target, so this 35% can be provided to any sector under the priority sector lending. So now this 35% voluntary allocation has been reduced to what percentage? First of all, it has been reduced to 20%. So now 40% plus 20%, that is the total target, has been reduced from 75% to 60%. So this is the basic idea. So yes, the right answer here is 20% and 60%. Okay, so basically the small finance bank was required to provide 75% of A and BC to the priority sectors, in which 35% was voluntary allocation by the small finance bank to the different priority sectors. Now it has been said that this voluntary allocation is going to be decreased from 35% to 20%, and that's why the total allocation is going to decrease to 60%. So here the right answer is C. So on a review, it has been decided that from 2025-26 onwards, the additional component of 35% of priority sector lending shall be reduced to 20%, thereby making the overall priority sector lending target for small finance banks 60%. Okay, this is the basic idea. Okay, so the small finance bank shall continue to allocate 40% of the adjusted net bank credit to different subsectors under the priority sector lending guidelines as per determined by the priority sector lending guidelines, but the additional 20% is determined by the small finance bank, that in which sectors this 20% has to be allocated. Okay, so 40% is as per the priority sector lending guidelines, but this 20% can be decided by small finance bank that where they want to allocate this 20% in which priority sectors particularly. So this is the idea. Now coming to the next question, that is the APS, that is about the Aadhaar enabled payment system. Okay, so all the students that have given the right answer of the previous question, give yourself 1 mark and try to answer this question now. Yes, so Aadhaar enabled payment system. So this is a very important system through which the payments can happen through the Aadhaar information and biometric details. Okay, so Aadhaar enabled payment system, there were many frauds that were happening when you were paying through the Aadhaar enabled payment system, and to reduce these frauds, there were guidelines that were brought by the Reserve Bank of India, okay, or there were guidelines that were introduced by the entity, by the NPCI. So now it has been said that in cases where the Aadhaar enabled payment system touchpoint operator has remained inactive, has not performed any financial or non-financial transaction for a customer for a continuous period of how many months? So it is 3 months. Okay, the answer here is yes, everyone is giving the right answer. The answer here is 3 months. So basically, if the APS touch point operator, that is also known as ATO, if the ATO has remained inactive, or that means has not performed financial or non-financial transaction for a customer for a continuous period of 3 months, then the acquiring bank has to do the KYC again before enabling him or her to transact further. Okay, so this is the basic idea. So we have discussed about Aadhaar enabled payment system. That means through the Aadhaar details, through the biometric details, the transactions can happen even if you do not have UPI, even if you do not have the RTGS or NEFT system or internet payment system and such, but through your Aadhaar details that is connected with the bank account and through your biometric, you can easily do the transactions with the merchants. Okay, so this is the idea. Now it has been said that there are the guidelines that have been brought to make this APS more safer, as well as the ATO, they need to have the KYC again, or the acquiring bank need to do the KYC again in regards to the ATO. Okay, next is Reserve Bank has released data relating to India's international investment position for end March 2025, in which it has been notified that what is the India's liabilities as well as what are the India's assets at the global level. So over %, of the rise in India's overseas financial assets was due to increase in overseas direct investment as well as currency and deposits and reserve assets that is maintained by the Reserve Bank of India. So here try to answer this question, that over what percentage of the rise in India's overseas financial asset is because of overseas direct investment that we are doing, currency and deposits as well as reserve assets. So India's liabilities, that means we have the liabilities, that is the money that we have to return. So if we are getting the deposits, if we are getting the investment, so this is the liability that we have to return. Okay, this is the India's liability. India's assets are the assets. Let's say we are doing the investment. So this is the asset that we have. So if we are doing investment at the global level, or if we are depositing at the global level, so these are the assets that we have. So over 72% of the rise in India's overseas financial asset was due to the overseas direct investment that we are doing, currency and deposit that we are doing in the global environment, as well as the reserve assets that we have. So here the right answer is 72%. Very good. So C is the right answer. And why this data point is very, very important, because it was also mentioned directly in the newspapers. Okay, so it was also mentioned in the newspapers. So over 72% growth in India's overseas financial assets was due to investment, currency and deposit and such. Now all the data points we have discussed, just the important data point is this 72%, as well as the ratio of India's international financial asset to international financial liabilities has increased to 77.5% from 74.1% a year ago. Now coming to the next question, that banks can now use the ratings of Care Edge Global IFSC Limited for risk weighing their claims on non-resident corporates originating at International Financial Service Center. The rating risk weight mapping has been provided, where it has been said that the BB minus and such, these ratings will have a particular risk weight. Okay, so if the Care Edge Global IFSC is providing the rating of BBB, what is the risk weight that will be attached to that? So what is going to be the risk weight? So usually the BBB has the risk weight of 100%. Very good. Give yourself 1 mark. Keep on giving yourself 1 mark for the right answers that you are doing, and give yourself negative 0.25 marks if you are giving a wrong answer. Okay. So here the right answer is 100%. That is T. So this is the idea, that it was said that the banks can now use the ratings of Care Edge Global IFSC Limited for risk weighing their claims on non-resident corporates. So that means the Care Edge Global IFSC, it can provide the ratings, but it can only provide the ratings for the non-resident corporates and the instruments of the non-resident corporates that are operating at the IFSC. This is the idea. Now there are different ratings that can be given: A, BBB, BB and below. Okay, so that means the risk weight has been allocated 20% for the AA instrument, as well as the risk weight of 30% for the ranking of AA. So this is the basic idea. Now coming to the next question, that RBI has clarified that loans against voluntary pledge of gold and silver. So this was quite in news. The voluntary pledge of the gold, like the pledge of the gold and silver. So gold and silver ornaments as well as gold and silver coins can be used as collateral for taking the loan, right? This can be used as collateral for taking the loan, but there are certain collateral free loans. Now it has been said by the Reserve Bank of India that even for the collateral free loans, the farmers or the people that are doing the allied activities, as well as the MSMEs, for the collateral free loan also, they can provide the collateral in the form of gold and silver. So you are voluntarily providing the collateral. If you are voluntarily providing the collateral, so you will get the benefit of lower interest rate or easier terms and conditions. So the collateral free loans for the farmers is what? So basically the loan limit of collateral free agricultural loans, including loans for allied activities, of 1.6 lakh, it was raised to what amount? It was raised to 2 lakh. Very good everyone. Everyone has given the right answer. So this was raised to 2 lakh. So here basically you can understand that the loan limit was increased. First of all, it was increased previously, and now it has been said that for the collateral free loans also you can provide voluntary collateral. So the loan is collateral free, but you can voluntarily provide collateral. If you are providing the collateral, the banks are more safe, they are feeling more safe, and there is less risk involved. Okay, so if there is less risk involved, there can be easier terms and conditions that can be used, as well as lesser interest rate that can be charged by the bank. This is the basic idea. I hope this is very much clear. So here the answer is B. Basically it is clarified that loans against voluntary pledge of gold and silver collateral. So there are collateral free loans. There are collateral free loans for the micro and small enterprises, as well as for the farmers, for the agriculture and allied activities. There are, to a limit, there are collateral free loans that is provided. In those collateral free loans, if you are doing the voluntary pledge, then you will get better conditions of the loan. This is the idea. Now coming to the next question, read the question very carefully and try to answer this question. This is regarding the prepayment charges on loans. This was quite in news. It was the RBI notification. So this is the RBI notification, as well as this was quite in news recently. So try to answer this question. I'm giving you 1 minute to answer this question. Okay, so Krishna is asking that what is non-resident corporates? The non-resident corporates means these are the corporates, these are the companies that are not Indian. So they are the foreign companies and they are established in the IFSC, that is International Financial Service Center. So non-resident corporate, non-resident means they are not Indian companies. They are not residing in India. Okay, so they are residing in IFSC. Now I have got the answers from many of you. So some are saying A, okay, and some are saying D. So let's see what is the right answer. So first of all, which of the following statement is or are correct? So these directions shall apply to all commercial banks excluding payment bank. So payment bank cannot give loans. If they cannot give loans, they cannot have prepayment charges on loans. Okay, so this statement seems correct. For all the fixed rate loans, first of all, this prepayment charges norms have been brought for floating rate bonds, for the floating rate loans. Okay, so for all floating rate loans granted for the purpose other than business to individuals with or without co-obligant, and RE shall not levy prepayment charges in this case. So this is incorrect statement because it is a floating rate loan, not fixed rate loan. So for all the floating rate loan that is given for purposes other than business to the individuals, this should not have prepayment charges, right? Next is the small finance bank, regional rural bank, NBFC middle layer shall not levy any prepayment charges on loans with sanction amount of limit up to 50 lakh for all the floating rate loans granted for business purpose to individuals and MSCs. So basically, prepayment charges should not be taken from the people, or the prepayment charges should not be taken if the loan is of up to the limit of 50 lakh. This is the idea by these entities. So here the third statement is wrong. Second statement is also wrong. So the correct statement is 1 only. So the right answer here is D. D is the right answer. So all the students that gave the right answer, give yourself 1 marks. If you have not given the right answer, give yourself 0 marks or negative 0.25. Okay. So here you have to read the statements very, very carefully, because these guidelines, again and again I have told you that these guidelines were only for floating rate loans. Okay. So basically the prepayment charges, it was said that the prepayment charges should not be taken on the loans, especially if they are the floating rate loans. Okay. The applicability criteria is always very important. So these norms are applicable on all the commercial banks excluding the payment bank. So these are the applicable, like this is the applicability that you have to remember. Now the next point that was important in this direction was that the norms are for floating rate loans. Okay, so for all the loans, for all the floating rate loans that is given for purposes other than businesses to the individuals with or without co-obligant, and regulated entity shall not levy prepayment charges. Okay, for all the loans that is given for the business purpose to individuals and micro and small enterprises, there should be no prepayment charges if the loan is given by commercial bank excluding small finance bank, regional rural bank, local area bank, or the loan that is given by tier 4 primary urban cooperative bank, NBFC upper layer, or all India financial institution. There should be no prepayment charges. But if the loan is given for the business purpose to the individuals or micro and small enterprises by the small finance bank, regional rural bank, tier 3 urban cooperative bank, state cooperative bank, central cooperative bank, and NBFC middle layer, so they can levy the prepayment charges if the loan is above 50 lakhs. This is the idea. Okay. Now next question is in front of you. This is a statement based question, so try to answer this question. This is in regards to your electronic trading platform directions. So the Reserve Bank of India released the electronic trading platform directions 2025. Which of the following statement is not correct in regards to the criteria for the electronic trading platform? Okay, so try to answer this question. So here, first of all, the entity shall be a company incorporated in India. That is correct. The entity seeking authorization as an ETP operator or a minimum. So the entity seeking authorization as an ETP operator or a minimum of 2 of its key managerial personnel shall have experience of at least 3 years in operating trading infrastructure in financial markets. So it is not 5 years, it is 3 years. The entity seeking authorization as an ETP operator under these directions shall have a minimum net worth of 5 crores. This is correct. As well as they have to have the robust technology, they need to have the ensure capability to disseminate trade information on a real-time basis. So these other statements are correct. The second statement was incorrect. Okay. So B is the right answer here. Everyone has given the right answer. Very good. So here the ETP, as we have discussed the master direction. So here you can see that all these sessions, like on all the topics, I have taken the session. I have taken the session on prepayment charges also. So here on the gold and silver collateral. So all these topics, like all these topics, I have taken session on. That's why the snippets have been taken from the PPT directly. So if you have been seeing Finance 360-degree sessions, then you would be able to know about these topics, and there is no explanation that is required if you have seen the sessions already. Okay, so I have taken all these topics in the Finance 360-degree session. If you forget some of the topics, so do see the session again, or do read the PPT again, the PDF of the PPT that is provided to you. So electronic trading platforms, these are the platforms where the over-the-counter derivatives or over-the-counter instruments can be traded. Okay, so they are the electronic trading platforms where the trading can happen outside the exchanges, outside the NSE, BSE. The trading can happen over the electronic trading platforms. And now the RBI has released the master direction for the directions for the electronic trading platform, where it was notified that if you want to become the electronic trading platform, or if an entity wants to become the electronic trading platform, they have to follow certain general criteria, financial criteria, as well as technological criteria. General criteria basically means the entity shall be a company incorporated in India. They must have certain experience, as well as there is financial criteria and technological criteria also. So this is the most important idea, the criteria you need to remember about. Now the next direction and the next question is about the project finance. This is one of the most difficult direction that the RBI has released. Project finance means basically the finance is required, or the money is required. The money is required for the infrastructure financing, or for the financing of the commercial real estates and such. Okay, so the money or the finance or the loans or the the finance is required for the infrastructure financing and for the commercial real estate. But sometimes what if these projects, it is said that these projects will start working from 1st January 2026, and from that day onwards, from 1st January 2026 onwards, they will keep on repaying the amount that they have taken. But what if they do not start their functioning from 1st January 2026? Recently you have seen that how much of the rain is happening, there are floods that are coming in certain areas. So because of the various problems, because of the supply chain disruption, let's say that the infrastructure project or the commercial real estate is not able to operate from 1st January 2026, and they are operating from 31st. They have said that we will operate from 31st April 2026. That means they need around 4-5 months to start the operation of their project. So many of the banks that have given the money for this project, so these banks face problem, right? So for these kind of project financing, for the infrastructure finance, for the infrastructure projects and commercial real estate and such, there is this direction that the RBI has released, that is the Reserve Bank of India Project Finance Direction. Now this is applicable for all the commercial banks, including the small finance bank, but excluding the local area banks, payment bank and regional rural banks, because regional rural banks, local area banks and the payment bank, they are not capable enough, we can say, or they are very small to provide loans for such kind of big projects. Okay, that's why this statement is wrong, because there is local area banks that are also excluded from the project finance norms. Okay, so on the all non-banking financial companies, including housing finance companies, the primary urban cooperative banks, all India financial institutions, the directions are applicable on these institutions but not on local area banks. So 2, 3 and 4 is the correct statement. Okay, so D is the right answer here. Here you can see applicability. So all the commercial banks, including the small finance banks, but excluding the payment bank, local area banks, regional rural banks, they are excluded from the project finance norms. I have taken a complete session on the project finance loan. I hope you remember the basic details. Okay, so basically date of financial closure means that on this date you have got at least 90% of the funding for your project. Okay, or you have found the resources or the sources from where you will get the funding. Okay, original date of commencement of commercial operation means the original date that you have given, the 1st of January 2026. Extended date of commencement of commercial operation, you have said that from 31st April 2026 the project will start now because of the delay. Now actual date, that is the actual date, let's say from 21st of May 2026, the operation is starting, the project is starting. Okay, now coming to the next question, continuing with the project finance direction. So here it is said that in under construction projects where the aggregate exposure of the lenders, so in under construction projects where the aggregate exposure of the lenders is up to 1500 crores, no individual lender shall have the exposure which is less than how much percent of the aggregate exposure for the projects where aggregate exposure of all lenders is more than 1500 crores. The exposure floor or the minimum percentage for an individual lender that has to be invested is dash percentage or 150 crores, whichever is higher. So here it is 10%, here it is 5%. So for under construction projects where the aggregate exposure of the lender is up to 1500 crores, individual lenders exposure should be which is less than 10%. Okay. So no individual lender shall have an exposure which is less than 10%. That means all the lenders should have enough of the money in the project or should have enough of the interest in the project. So no individual lender shall have an exposure which is less than 10%. As well as for projects where aggregate exposure is more than 1500 crores, the exposure floor, that is the minimum exposure for an individual lender, shall be 5%, at least 5% or 150 crores, whichever is higher. So 10% and 5%. Okay. So okay, many of the students have given the answer for this question also. Give yourself 1 mark and well done. So these are the norms that you can see for the projects that is financed by a lender, or multiple lenders are usually involved for the infrastructure projects, for the commercial real estate and such kind of projects, for the infrastructure projects, for the other projects and such. And basically it is said that the tenure of returning the loan should not be exceeding 85% of the economic life of the project. That means, let's say the project is expected to earn returns for 10 years or for 12 years. So the return of the amount or the return of the loan should happen within 85% of the economic life of the project. Okay, this is the basic data points. Now the next point is that what if there is some stress that is coming on the loan. So loan has been given for a project, the loan has been given for a project, for the infrastructure project or for the commercial real estate project or for any other project, the loan has been given by multiple lenders. Now the lenders are finding that the project will not be able to operate on the given date. That means we have to extend the date of operation and the return of the money. As well as, let's say, the lenders are recognizing that the project requires more money. So there might be some stress that is involved in the project. Okay, so there might be different kind of stress that might come in the project, and that stress has to be recognized, and it is known as credit event. Default with any lender, that the interest payments that were given till now that have not been paid. Any lender determines a need for extension of the date of operation, as well as any lender determines a need for further infusion of funds, or the project is faced with financial difficulty and such. So in this case, the credit event or the difficulty or the stress has to be informed to the central repository of information on large credit, as well as there should be a prima facie review. Review should happen of the credit event, that the credit event or the stress is just basic stress because the rain is happening, because the flooding is happening. That's why the project has to be stopped for a short period of time. The stress is a very big stress or it is a very small stress that we will be able to tackle, or the project owner will be able to tackle. Okay, so there should be a review should happen, that should be within 30 days from the date of such credit event. Okay, and there should be a proper review and the resolution plan has to be provided. Now the next question is regarding that credit event and the resolution plan. So if a resolution plan is given and the resolution plan is just saying that extend the date of commencement of commercial operation. So for the project, the date has to be extended, or let's say like small funds has to be given for the project because the project requires certain more funds. So if that has to happen, then the resolution plan is created, that we have to resolve the problem, we have to resolve the stress that is coming in the project, and the lenders are giving more funds or the lenders are extending the timeline. Now if the resolution plan is safe, then the loan will still be considered standard loan, will be considered standard loan. So standard loan will be considered in which of the following criteria? Okay, try to answer that. So basically, permitted deferment or the delay that is happening of the date of commencement of commercial operation from the original date up to 3 years for infrastructure projects and up to 2 years for non-infrastructure projects, including commercial real estate or commercial real estate residential housing and such. So this is correct, that if the permitted deferment or the permitted delay that is happening in the project operation, that is 3 years for infrastructure projects and 2 years for the non-infrastructure projects, this is allowed, and still the loan is considered standard and the project is considered good. Okay. Now cost overrun has happened. The cost is running over or the cost is increasing, but it is maximum up to 10% of the original project cost in addition to the IDC. So basically in the initial plan, the cost that was said that it is going to be 100 crores or 200 crores. So the cost overrun is maximum up to 10% only. That much open niche is possible, or that much up and low is possible in the cost. So that this is also allowed, not 5%, 10%. 10% is allowed. So this is wrong. The rise in project cost excluding any cost overrun in respect of the original project is 25% or more of the original outlay as the case may be. So this is also true. This is also correct. Okay. So the first and the third statements are correct. If these are happening, then the project, even if it is under stress, it is considered standard. Okay. Because it is coming under the resolution plan. So the second statement is incorrect, and that's why the right answer is E. The right answer here is E. Okay. Not correct. Which of the following statement is not correct? So here the E is the right answer. So read the questions very, very carefully, because correct, incorrect, there are going to be 80 questions in the phase 1. So correct, incorrect, you might get confused. So do read the questions very carefully. Okay. So E is the right answer here. And here you can see that a project finance account classified as standard, it can be classified as standard if a resolution plan is provided and the resolution plan is following these criteria. That is, the permitted deferment or the delay of date is up to 3 years for infrastructure projects and up to 2 years for the non-infrastructure projects. Cost overrun up to a maximum of 10%, as well as the financial parameters are being met, that the financial parameters are still good, as well as the 25%. The rise in project cost, excluding any cost overrun is in respect of the original project is 25%. That means if the project is further expanded, let's say the project was saying that we will build a road for 25 kilometers. Now the project is saying that just 5 kilometers more we are going to build the road for 5 kilometer more, because that will provide more profit. Or let's say a commercial like real estate is being built, and it was said that we are going to build 9 floors and we require 100 crores for that. Now it is said that we are going to build 2 more floors for more profit, like we are going to build a swimming pool and such. So we require 10 crore more. So that means if there is the scope or the size of project is being expanded, in this case it is allowed to rise the project cost, because there is more expansion of project that is happening. So the project cost is allowed to rise up till the percentage 25%, up till 25%. So project cost is allowed to rise excluding any cost overrun in respect of the original project is 25% or more of the original outlay as the case may be. So 25% or more, this is allowed. Now coming to the next question. So project finance, these directions were most difficult, but I have given you a brief overview so that when you go through the PPT, you can revise everything clearly. Okay. Now coming to the next question. Now the easier questions are going to come. Financial Inclusion Index. Everyone, I hope you know that how important the Financial Inclusion Index is, and I hope you know the answer of this question. So try to answer this. That the Financial Inclusion Index has been recently released by the Reserve Bank of India. The value of the Financial Inclusion Index for March 2025 stands at what percentage? Again 64.2 in March 2024. So it stands at 67, right? Yes, the answer is 67 here. Very good, everyone. So here basically Financial Inclusion Index, it shows the financial inclusion in our country. If the financial inclusion value is near to 0, what does it mean? And the financial inclusion value is near to 100, what does it mean? So basically currently the financial inclusion value is 67. So that means it is near to complete financial inclusion, and 0 means complete financial exclusion. So value near to 0, 0 actually means complete financial exclusion, and 100 means complete financial inclusion. So the value, the value, financial inclusion index value, the more it is near towards the 100, the better it is. That means the better the financial inclusion condition is in our country. Okay, coming to the next question. So if you know about the financial inclusion index, you will easily be able to answer this question. So try to answer this question now. So here I am getting the answer. Okay. So read the question carefully. The question is saying that which of the following statements is incorrect in regards to the financial inclusion index. So the index is responsible to, or it is responsive to, three parameters: access, usage, and quality. So basically the index is responsive to access, usage, and quality, comprising of 97 indicators. Correct. Financial inclusion index has been constituted without any base year. Correct. Next, the index captures information. So the value that has been provided for the financial inclusion index, the index captures information on various aspects of financial inclusion in a single value ranging from 0 to 100. 0 means complete financial exclusion, 100 means financial inclusion, complete financial inclusion. Improvement in financial inclusion index in financial year 2025 is contributed by usage and quality dimensions. Okay, so a previous year question has come in the RBI grade B last year. There was a question regarding the improvement in digital payment index is because of which parameter. Similarly, here also a question can come that the improvement in financial inclusion index is because of which parameters. It is because of usage and quality parameters. Now the quality has the weight of 20%. And quality means consumer centricity, consumer protection, inequality has to be reduced in the financial segment and improving the financial literacy. So this is correct regarding the quality. So here the answer is D, because D was the wrong statement. The improvement has happened in the financial inclusion index in regards to the usage and quality. Okay. Okay, very good. So this is about the financial inclusion index. I have taken a session on this also. So I hope you know about it and do see that in the PDF. The highest weightage is given to usage, 45%. Okay. Now coming to the next question. So recognizing the need to enhance the consumer protection, the KYC norms were amended. There were amendment that happened to the KYC norms. Try to answer this question. So I have taken a session in the Finance 360 regarding this question also. So there was amendment that was done in the KYC norms. So which of the following statements is or are correct in this regards, in regards to the amendment that has happened in the KYC norms? So first of all, for low risk individual customers, regulated entities shall continue to allow all transactions even if the KYC is due. Is it allowed? For the low risk individual customers, is it allowed to continue with the transactions even if the KYC has not happened or even if the KYC is not updated? So yes, it is allowed, but the allow or the allowance is given for only up to 1 year. So this is provided KYC is updated within 1 year from the due date or by June 30, 2026, whichever is later. So actually for the low risk customer, it is allowed that the transactions can continue even when the KYC is due, but the KYC should happen within 1 year or by June 30th, 2026, whichever is later from the due date. Okay. Now banks may obtain a self-declaration from customers in case of no change in KYC or address is only changed, then the business correspondent group or the business correspondent agents and such can be used for this kind of small task. Okay, so this is correct. Now banks must update the KYC in their system and inform the customer post updation. Final responsibility for KYC updation remains with the business correspondent. Now which of the following statement is or are correct? B, 2 only. So second statement is only correct? Absolutely correct. So see, the final responsibility for KYC updation remains with the bank, because bank is finally liable. Business correspondents are just the extended arm of the banks. They are just the agents of the bank. So the responsibility should be with the bank itself. Okay. So first and third statements are wrong. Only the second statement is true, and that's why the answer is B. Good to see that many of you have read the statements very carefully, and that's why you were able to answer this question correct. Okay. So B is the right answer. Basically, the KYC update has happened in which it was said that the business correspondents can be used, the agents can be used for the KYC update in case there is no change in KYC information or changes only in the address. Then the business correspondents can be used, and their business correspondents and the agent groups can be used and such. Business correspondents have to share the information with the bank. The bank is finally responsible for updating the information. This is the basic idea. Now, it was also said that the banks have to update or there should be periodic updation of the KYC that should happen, because it was recognized that there was a large pendency in periodic updation of KYC, including in the accounts opened for credit of direct benefit transfer. So for the direct benefit transfer, there were many accounts that were opened, but the KYC norms have not been completed or they have not been updated. That means there is Kisan Samman Nidhi. So many of the farmers, they should get rupees 6,000 per year, that is rupees 2,000 in the quarter basis. So many of the farmers, they have the direct benefit transfer. For the direct benefit transfer, for the transfer of the money, they have the accounts. But the KYC has not been updated. So how we can say that the farmers are getting the money or not? What if there is the change in details that has happened, okay? And such. And the farmer, they are not even using the accounts, maybe, let's say. So it is said by the RBI that update the information for the accounts where the credit is happening for the direct benefit transfer as well as electronic benefit transfer under the government schemes to facilitate the credit of the DBTs. As well as there are many of the accounts that are opened for the scholarship, for getting the scholarship. So updation of KYC should happen on the regular basis. Next is, it is said that inoperative accounts or unclaimed deposits that are not claimed for 10 years, if the customer now wants to update the KYC, they can do so. They can do so through the video customer identification process. The KYC can happen and the update can happen. So basically, if the account has been inoperative till now for, let's say, past 10 years, the account has been inoperative, but now the customer wants to use the account, then the KYC process should continue or the KYC process should be used. Okay, so this is the idea. Now coming to the last question for today, try to answer this question. So this is in regards to investment in alternative investment fund. Basically, it is said by the Reserve Bank of India that the regulated entities under the Reserve Bank of India, they can invest in the alternative investment funds, but there are certain guidelines that the regulated entities have to follow. Alternative investment funds, they are the privately pooled funds, that is pooled from the sophisticated investors to invest the money. Like we invest in mutual funds, we are investing our money in the mutual funds, then the mutual funds are investing the money in different securities, okay, to provide us profit. Similarly, the banks, financial institutions, insurance companies and such, they invest the money in the alternative investment funds, that is the privately pooled fund, that is the privately pooled money, and this money is invested in the different securities, okay. Now the regulated entities like the NBFCs, banks, they can invest in alternative investment fund if these conditions are being followed. That means no regulated entity shall individually contribute more than 10% of the corpus of the AIF scheme. Absolutely correct. Collective contribution by all the regulated entities under the Reserve Bank of India in any AIF scheme, they shall not be contributing more than what percentage? So the collective contribution by all the regulated entities in any AIF scheme shall not be more than 20%. Shall not be more than 20% of the corpus of the scheme. If a regulated entity contributes more than 5% of the corpus of an AIF scheme, which also has a downstream investment in a debtor company of the regulated entity, that means regulated entity has a debtor company and the regulated entity is investing in the AIF, that is investing in this debtor company through the debt instruments, then this is a downstream investment. That means if a regulated entity is contributing to the AIF more than 5% of the corpus that is having the downstream investment, in this case 100%, of the provision has to be kept to the extent of its proportionate investment that is happening in the debtor company through the AIF. So this is also correct. So first statement is correct, third statement is correct, and that's why the answer is C here. So this is the answer here. 1 and 3 are the correct statements. So again, I have taken a session on the investment in AIFs directions also. So I have taken a session on this also where we discussed about the limits. So these are the 4 important points. The individual limit is 10%, overall limit is 20%, and then there is the downstream limit also that is there. Okay. So these were the questions. Now before ending the session, and first of all, you have to tell me in the comment section below that how much marks you have got out of 15. Let's see how many of you have got 10 plus marks. If you have got 10 plus marks, then it is a very good thing that you are you are revising continuously, because even getting 10 plus is good for now. This is, I think this is your first level of revision or first time reading that you are doing. Now you have to continuously keep on updating yourself as well as keep on revising. Okay, so for the first level of revision, this much marks is good for now. Okay, now these are the different sessions that we are taking. These are the different series that are going on for the different components. For the schemes, we have the sessions. For the finance current affairs and the RBI notification, RBI press releases, we have finance 360 degree. For descriptive answer writing, we have the perspective 360 degree, and for the current affairs, we have the CT 360. Okay, so I hope you have got good marks, everyone, more than 10 plus, I think. Okay, do see your negative marking and such also. So do tell me in the comment section below that how much marks you have got. And I am hoping that the people that are continuously watching the finance 360 degree series, at least they should get 10 plus marks. Okay, if you are not getting 10 plus marks, that means you are not revising after the session. So all the best for all of you. I hope you have got good marks, and I hope you are preparing well for the examination. So thank you everyone. See you in the next session. That is tomorrow only. So tomorrow we are going to discuss about the few topics that are important from the finance current affairs. Okay, so let's meet tomorrow now. Thank you.